Hello and welcome to this video on the balance of payments. So in this video we're going to first look at whether current account deficits are a source of concern, and then secondly we're going to look at some different approaches the government might take to reduce a current account deficit. So a quick reminder, we're talking here about current account deficits, so that's where we have a negative balance when we consider the trading goods and services, other income and transfers. Now in the UK we've been running consistent current account deficits for a number of years, and we can see recently the current account deficit, so the value of this deficit, let's say 60 billion or whatever, is currently it's 4.1% of GDP. So comparing the current account deficit to the size of the overall economy. So effectively this is the leakage that's happening to the UK GDP, 4.1%. Now, should we be concerned about this? Should we be concerned that a country has a current account deficit? So those in the yes camp would argue that it just feels wrong. It just traditionally seems as worse than a surplus. The idea that you're spending more than you're earning as a nation of households and businesses. Often the argument goes that large current account deficits are financed by borrowing from abroad. And this could be problematic if lenders want their money back or by leaving debts for future generations to deal with. But those in the no camp would argue that if the imbalances are quite small compared to GDP, so maybe 1 or 2%, then this might not be problematic. It's quite insignificant in terms of what's happening to the economy as a whole. And whilst we might say, oh, large surpluses are good, they could indicate that resources are being more focused on exports rather than meeting domestic demand, resulting in a low standard of living. So if you have a look at the countries that have current account deficits and the countries that have current account surpluses, you might ask yourself the question, where would you live? Which country has the highest standard of living? The one that's importing and consuming, or the one that's exporting and producing? So an argument might go, the actual people who live in the export-driven country don't get to consume these products and so don't have a high standard of living. So let's look at the UK's position in a little bit more detail, and this applies to many Western advanced economies. We have seen increased imports from China and India, and they have replaced traditional manufacturing, leading to a current account deficit. But we have to question how many of these goods are actually Indian or Chinese. Many of these are researched and designed in the UK, or they're done by UK-based companies who then move the manufacturing to abroad. So for example, if I have a UK-based company that has a company that's based traditionally in the UK and has outsourced manufacturing to India, then technically we have imports of goods from India and we have the money flowing to the company in India, so we have a current account deficit. But this company in India is actually owned by a British company, for example, maybe a company like Dyson, and as the money flows from the UK to India, this company abroad increases in value, so it gets wealthier. But ultimately, who is it who owns this company? It's the investors, the shareholders who are based in the UK. So we can get current account balances looking as though they're just being quite a distortion, quite an issue, but actually, if this balance is still being owned by investors in the UK, maybe it's not such an issue. So there's a number of ways we might evaluate whether a current account deficit is a cause for concern or not. Let's imagine it is a cause for concern. We're racking up too much debts, businesses are lacking revenue, there's a leakage from our economy, so we want to reduce the current account deficit. What do we do, or what measures can we have? Broadly speaking, we have three approaches here. The first one on the left-hand side is just to allow the market to correct through a floating exchange rate. The second and third require some government intervention. Effectively, if we don't want people to import as much, we can try and switch their spending. So we can try and switch their spending from imports to domestic products. Or the third one, which normally is not that popular, we can try and reduce how much people spend in total so that they buy less imports as a whole. So let's consider the first one. Why might a floating exchange rate approach actually help solve a current account deficit? Well, if a currency is truly floating, then a current account surplus should cause a depreciation in the currency, because we have a lot of imports. In order to do that, we have to sell our own currency, which weakens its value. Now, in the longer term, this weaker currency should make our exports more competitive and imports less attractive. Therefore, the floating currency should allow a current account deficit to correct itself in the long run. However, this does depend on all the other factors that will influence the exchange rate, like interest rate, speculation, financial flows, quality of goods and services of the actual products involved, so this won't always occur. In which case, the government may decide to intervene and we move on to our expenditure switching or expenditure reducing policies. The first expenditure switching policy we're going to look at is the concept of devaluation. So a quick reminder of how this works. The government might intervene in the foreign exchange market to fix the value of their currency at a lower value. This makes imports more expensive and exports more competitive. So the value of imports falls and the value of exports rises. The current account deficit is reduced, although there's always the risk of retaliation from other countries, and surplus countries may have already devalued their currency in order to use this tactic, so therefore it's very difficult for deficit countries to also do this. Now, devaluation comes with three good forms of evaluation, where we question the circumstances under whether devaluation will work or why it actually might have a negative impact. So will this devaluation work? Well, really, it depends. Let's look at some evaluation of our devaluation. We're going to do this by looking at a scenario. We're going to imagine we're based in the UK, and currently we're going to consider trading to our major trade partner in the USA. So the relevant exchange rate here is $1 to the pound, and we're going to assume it's $1 to £1. So here we have the price of imports and exports in the UK. So an imported American good into the UK, well, in America it's priced at $12. So in the UK the price would be £12. And the price of an export, a UK export to America, well, they cost £10 in the UK, so in America they would appear as $10. And we're going to imagine that we import and export 100 of these. So there are 100 American imports into the UK and 100 UK exports to America. What would be the value of the imports and exports from the UK's perspective? Well, the value of American imported goods would be £1,200, and the value of exported UK goods to America will be £1,000. So our current account balance would be a deficit of £200. Now let's imagine that the UK government is not happy with this deficit, and so they decide to devalue the currency, i.e. make the pound weaker or the dollar stronger. So they move the exchange rate now to $1 equals £1.50. Now let's think first of all about what impact that would have on the price of imports and the price of exports. Well, the price of an American import into the UK, well, the price of the American import in America, the price of the American product would stay the same, 12. But now in the UK, this product would appear as £18. If we consider the UK export to America, well, the price in the UK would still be the same, it's £10 in the UK. But now the price of this export in America would appear as $6.66. So what we'd expect is we'd have less imports and more exports as a result of the devaluation. But really what we haven't figured out, or we haven't taken into account quite yet, is the change in the quantity. We've changed the price, we also need to change the quantity. And you might recall this is linking back to price elasticity of demand. By how much will the quantity demanded change if we change the price? And we can consider two scenarios here. One, if it's price inelastic demand, and one if it's price elastic. So let's look, if the quantity is price inelastic, what might be the impact? So if quantity is price inelastic, it means quantity is not going to change by very much. So even if the prices change, so the price now has gone up £18 or down $6.66, the quantity is not going to change by very much. So maybe now we import less, of course, because they're more expensive. They've gone up by £6, but we only import 5 less. In terms of exports, yes, we export more because it now appears cheaper in America, $6.66 versus $10, but we only export 10 more. So what would be the value of imports and value of exports from the UK's perspective? Well, the value of imports is the £18 times 95, and the value of exports is the £10 again, because that's the value of that product at that exchange rate in pounds, multiplied by 110. So £1,100. So here, have we solved our current account deficit? No. Our current account deficit is even bigger. It's now £610. Whoops! Actually, the devaluation here doesn't work. It makes our current account deficit bigger. What, however, if the demand response was price elastic? So again, we've changed the prices. So it appears £18 in the UK and $6.66 in the US, the exports from the UK. But let's imagine now the quantity changes by quite a lot. Such that the quantity has gone up by 50. Sorry, gone down to 50 of imports into the UK, and now we're selling a lot more exports of 150. Well, what we can see is that the value of imports would now be 900 and the value of exports would be 1,500. So we would have a current account surplus of £600. Yay! This has solved our current account deficit. So the moral of the story, if we do a comparison here, is that devaluation will only work if the price elasticity of demand for imports and exports is elastic. In the elastic scenario, we've got a current account surplus. In the inelastic scenario, we've got an even worse current account deficit. So what is the moral of our story? Well, will the devaluation work? The extent to which the devaluation of a currency will lead to an increase in the value of exports and a decrease in the value of imports will depend upon the price elasticity of demand for imports and exports. A reminder that this is our formula for the price elasticity of demand. So if we imagine this from the perspective of the USA, who have a big current account deficit, and China, who have a big current account surplus, if the demand for Chinese imports in America is elastic, price elastic, then the devaluation will lead to a more than proportional decrease in demand for imports and a reduction in the total dollar value of imports. Similarly, if the demand for US exports is price elastic, then the devaluation will lead to a more than proportional increase in the demand for exports and an increase in the total dollar value of exports. If the value of exports rises and the value of imports falls, then we get a reduction in the current account deficit. And a lot of this research was done by an economist called Marshall and Lerner, and so we have what's known as the Marshall-Lerner condition. And the Marshall-Lerner condition states that devaluation will result in an improvement on the current account if the combined elasticities of demand for exports and imports are greater than 1, so price elastic. So if we look at the imports and exports and their price elasticity of demand, and over the course of the two together, that they have a price elastic effect greater than 1, then these two economists suggested that a devaluation will work and the current account deficit will be reduced or moved to surplus. And so we would say that the Marshall-Lerner condition applies if the combined elasticities of demand for imports and exports are price elastic. Okay, our next evaluation of devaluation is what's known as the J-curve effect. And this is really just similar to the Marshall-Lerner condition, putting an extra spin on it of short run versus long run. So in the short term, demand for imports and exports, or demand, tends to be more price inelastic. This is because it takes time for producers and consumers to react to the change in the value of the currency and therefore change the quantity that they buy and sell. So in the short term, we often see there'll be no increase in the value of exports and no decrease in the value of imports. In fact, the current account position may worsen, as we saw previously, under the price inelastic demand scenario. However, in the longer term, producers and consumers can adjust to the new prices, and the response might be more price elastic. And we saw that that would work. The current account position would improve. So if we were to look at our current account balance over time, here we have 0, our current account balance, and here we have a deficit. So we start off at position 1. In the short term, we have a deficit. So what do we do to try and reduce our deficit? We devalue. Now in the short term, the response to the change in price of imports and exports is likely to be quite inelastic. This is likely to worsen our current account deficit. So we'd move to position 3. However, as consumers and producers adjust to the change in prices over time, then we would have a more price elastic response in terms of demand for imports and exports, and we'd expect the deficit to be reduced and then possibly even moved into a surplus in the long term to reach position 3. And so what letter does this look like? Our red line, it looks a bit like a J, so we often call this a J-curve effect. In the short run, devaluations might make things worse in terms of the current account deficit, but in the long run, it should improve them. The final part of evaluation of devaluation is cost push inflation. So when we devalue, we make our currency weaker, which raises the price of imports. As a result, there may be imported inflation, i.e. the general level of prices in the economy rise because all those imported products prices have gone up. This could fuel a cost push inflationary spiral, and then the increased competitiveness achieved by the devaluation will quickly be eroded. So we've spent a lot of time there talking about devaluation. Our next way of tackling a current account deficit is protectionism. So protectionism is reducing the level of imports. So it's creating more business for domestic companies, reducing the value of imports and improving the current account balance. These are all different forms of protectionism that we could use in order to reduce the level of imports. So tariffs and quotas being probably the most common ones. We can also have joint ventures or using a local partner, restricting foreign ownership, local contents, or environmental health and safety regulations. Now let's move on to our expenditure reducing policies. So we could use these to perhaps reduce expenditure. So the first one might be fiscal policy. If we were to increase taxes to decrease how much consumers spend, so deflationary fiscal policy, as a result they may purchase less imports. Although a side effect of this would be it could reduce economic growth and possibly lead to recession. It's also likely to be an unpopular policy politically, trying to get people to spend less. We might consider supply side policies as a government, maybe education and training, to improve quality and therefore competitiveness of exports to boost export demand. But of course we might evaluate this by using opportunity cost. Finally, we could consider the use of monetary policy, perhaps raising interest rates to reduce disposable income and therefore consumption of imports. Although again, deflationary monetary policy may limit economic growth, and then there's no guarantee that consumers will switch away from imports, particularly if imported goods are cheaper. In fact, demand may increase. So in this video we've looked at whether current account deficits should be a cause for concern, and also looked at a range of different solutions that might be used to tackle a current account deficit, in particular focusing on devaluation and those 3 evaluation points of devaluation. That's it. Thanks very much for listening.